Welcome to the Deep Dive, the place we take the most complex, high-stakes source material and turn it into clear, digestible, and, well, actionable knowledge for you.
Today, we're embarking on a pretty ambitious deep dive. We're looking into what the people who really set the global agenda are talking about right now. Our source material is the January-February 2026 issue of Foreign Affairs.
And we're treating it as a single, massive editorial system. I mean, it's basically designed to tell us where the world is heading.
Exactly. And the overriding theme, and this is really critical to grasp from the outset, is this stark acknowledgement that the U.S.-led post-Cold War liberal order is, for all intents and purposes, defunct.
It's over. And what we're seeing is an acceleration toward what the sources are calling a New World disorder.
Right. Multilateral cooperation is, it's collapsing. Great power competition isn't some abstract threat anymore. It is actively reshaping the fundamental rules of global economics and finance as we speak.
That's really the core thesis. And our mission today is to filter these massive geopolitical shifts, this decay of political reliability, and pull out only the material implications.
We're focusing purely on the financial consequences, for economics, capital flows, markets, corporations, and of course, state power. We have to clarify the economic logic first.
Who gains, who loses, and how do these global fault lines translate into, well, monetary risk and opportunity for you, the listener?
And the overarching frame for this new disorder, it's not bipolar like the Cold War. It's a three-way contest.
Right. So on one side, you have the global West, that's democracies, and they're currently struggling with a lot of internal division and rising protectionism.
Then you have the global East, led by China and its authoritarian allies. And they are flexing this growing economic and military muscle, often, in lockstep with each other.
And then there's the third crucial player.
The global South, and this is so important. These are the middle powers countries like India, Brazil, Turkey, Saudi Arabia, who are not aligning rigidly with either side.
They're playing the field.
They're playing the field, they're pursuing multi-alignment, strategic diversification, they really hold the swing vote. Their economic and geopolitical choices will ultimately determine what the next era looks like.
So if the rulebook is being rewritten, the key question we're addressing for you today is intensely practical.
It has to be.
How should you orient yourself in a world where global political reliability is visibly eroding and economic strength is increasingly being, well, weaponized by state power?
A great place to start is to look at the economic bedrock of one side of that triangle. Let's begin with the fundamental nature of authoritarian power.
Okay, let's unpack this. We have to start with the financial logic of autocracies. The source material argues, and this is a big shift in thinking, that their stability relies less on satisfying citizens or, delivering high GDP growth.
And far more on mastering cash flow and utilizing sophisticated, pervasive internal repression.
This is a huge insight. It really challenges that old Western assumption that, rising tide lifts all boats, including totalitarian ones.
It does. Political scientists have been pointing this out for a while. Authoritarian regimes just don't rely on a social contract that's tied to economic performance in the same way democracies do. They simply don't have to face a ballot box if living standards dip.
So, if they don't need public satisfaction, what is the real contract? What's the deal?
It's starkly transactional. It's basically public loyalty in exchange for non-persecution.
As simple as that.
The true social contract is essentially, you give us your silence and compliance, and we, the state, promise not to come after you. The crucial economic point is that this survival strategy is financed by revenues that are completely independent of the citizenry's consent.
And where does that cash flow come from? Especially when we're talking about a heavily sanctioned state like Russia?
Well, it often flows from commodities that are just very, very difficult to sanction globally. Look at Russia's financial lifeline.
Oil and gas.
Oil and gas exports are key. They're funding up to a quarter of the war against Ukraine. And this revenue stream isn't just a number on a spreadsheet. It represents a tactical redirection of global supply chains.
And that's providing this crucial economic offset against all the Western sanctions.
Exactly.
We hear this number, $400 billion. That China, India, and Turkey purchased close to $400 billion in Russian oil since 2023. On the surface, that sounds like an outright failure of Western policy. Is that an accurate way to look at it?
Not entirely. I'd call it a successful tactical pivot by Russia, which was enabled by these strategic partners. So here's how it works. Russia sells the oil at a heavily discounted rate. We're talking maybe $20 to $30 below the global benchmark.
Okay.
China and India then either consume that cheap oil themselves or, and this happens more often, they refine it and then resell the refined products like gasoline or diesel on the global market.
Often back into Europe or other Western-aligned markets.
Precisely. They reap the profit difference. So these nations become, in effect, strategic financial intermediaries. They are complicit partners in circumventing the intended price caps.
That deepens the financial relationship between them in a really significant way. But, relying on the transport of massive volumes of oil and gas must create some highly specific financial vulnerabilities.
Absolutely. The money is only real once that commodity gets across the ocean. And Russia has built this incredibly sophisticated system to evade the G7 price cap. They've created what's called a shadow fleet.
Hundreds of aging, poorly insured tankers.
Decrepit in many cases. These ships operate completely outside of Western insurance and regulation. That drastically reduces shipping costs for Moscow, which translates directly into higher net revenue for the war effort.
But the sources we're looking at suggest the West is finally starting to target this mechanism.
Correct. This is where the financial pressure points are finally being properly identified. There are new EU draft proposals that would allow member states to legally detain Russia's shadow fleet tankers if they're found in their waters without adequate or, verified insurance.
And that would instantly raise costs for Moscow shipping.
Instantly. It would force them to find even riskier, more expensive alternatives. The logic here is crystal clear. If you can control the transport, you can control the revenue stream. You raise their cost of getting oil to market, you lower their available capital for military spending.
That makes perfect sense. Now, let's pivot from that external revenue to the internal financial commitment required to maintain this system. You mentioned repression, and the sources call this the paranoia premium.
That's a critical concept because repression is not free. It's a massive financial commitment. Compared to social spending, healthcare, or economic investment, these regimes extravagantly overcommit funds to surveillance, censorship, and security forces.
So we're talking about funding sophisticated internet monitoring systems, massive domestic intelligence agencies.
Advanced digital repression technologies, you name it.
So this paranoia premium is a significant financial drain that actively suppresses potential economic investment.
Precisely. It's capital that doesn't build roads or factories. It buys loyalty and it buys fear. And what's more, the structural paranoia goes even deeper.
How so?
Authoritarian leaders will deliberately assign overlapping jurisdictions to their security agencies. So you'll have the military intelligence, the internal police, the federal security services all watching each other. They're kept perpetually at daggers drawn.
So they're forced to compete and even actively sabotage each other just to prove their loyalty to the supreme leader.
Exactly. This internal rivalry guarantees that no single security service becomes strong enough to stage a coup.
That's a fascinating and, I imagine, incredibly expensive way to run a national security state. The very professionals in repression, the computer hackers, the counterintelligence units, are simultaneously the guarantors of the regime's survival and the greatest potential threat to it.
And it consumes enormous resources in the process. It's inefficient by design because it prioritizes political survival over operational efficacy.
Okay, so now let's widen the lens from a single state to what the sources call the Illiberal International. What is the sheer scale of this networked authoritarian spectrum, economically speaking?
The scale is immense, and it really demands attention from anyone in finance. If you take the authoritarian and the hybrid regimes and you put them together, they represent over 70% of the world's population.
70%.
But the financial punch is what really matters here. Their share of global GDP, and this is measured by purchasing power parity, hit 46% in 2022.
46%. And that's a massive jump from what, just 24% 30 years ago?
A huge jump. They have near parity economic heft now, and they're using it to cooperate and reduce the effectiveness of Western political and economic pressure.
So this cooperation provides economic and political lifelines, making sanctions much, much harder to execute unilaterally. How does that network translate into direct financial interference inside democratic nations?
It happens through illicit finance, which is used as a tool of geopolitical influence. The network provides the mechanism, shell companies, opaque jurisdictions, covert donations to bankroll political actors, and launder money directly into Western democracies.
This is state power being projected through finance.
That's exactly what it is.
We often hear the term laundromat. Can you detail the mechanics of that Azerbaijan example? How did they use illicit finance to spend nearly $3 billion in bribes?
Right. This wasn't a suitcase full of cash. It was much more sophisticated. The Azerbaijan laundromat utilize these anonymous, seemingly legitimate UK-registered shell companies.
On paper, they look like any other business.
Yeah. Any other business. These companies then layered billions of dollars through these incredibly complex chains of bank accounts, disguising the origin of the funds. The money was then used for a variety of purposes: buying real estate, funding lobbyists, and, critically, making covert payments to politicians and key bureaucrats across Europe.
So the money appeared to be just normal commercial transactions.
Exactly. It allowed them to finance, influence, and launder the state's reputation at the same time. They were essentially bribing European lawmakers to mute criticism of Azerbaijan's human rights record in places like the Council of Europe. It's sophisticated financial warfare using the West's own openness against itself.
And the example of the Hungarian bank loaning money to the far-right Vox party in Spain, that really highlights how states are using proxy organizations to influence internal political affairs.
That's a pure example of networked illiberal finance. A Hungarian bank, MBH Bank, which is partly owned by a very close ally of Viktor Orban, loaned about $10 million to the Spanish far-right Vox party. It just demonstrates how these financial levers are pulled across borders to fund political actors inside democratic nations who happen to share anti-EU or nationalist sentiments.
So the implication for markets, for corporations, for state power is just huge. These illicit financial flows are not random crime. They were strategic operations that exacerbate corruption, they actively fund political actors in democratic nations, and they tilt political playing fields.
And in doing so, they undermine liberal institutions from within, using the resources of the authoritarian network itself.
And the consequence for you, the investor, is that the political stability of democratic nations is now intrinsically linked to how effectively they can police their own financial borders against these foreign state-sponsored money laundering and influence operations.
It adds a whole new layer of geopolitical risk to what you might think are seemingly stable markets.
If that's the nature of authoritarian internal strength, let's look at how they project that power outwards. And here's where it gets really compelling. We see that China's competition isn't tactical retaliation, it's a long-term strategy. One source calls it a long economic war.
Yes, and it's focused on seizing dominance in future global markets and resources. This strategic framework is operating across 5 key frontiers all at the same time.
5 frontiers, what are they?
You've got the deep seabed, the Arctic, outer space, the cyber realm, and the international financial system. And Beijing's playbook is remarkably consistent across all 5.
Which is?
Invest massively in hard capabilities, embed Chinese experts into international governing bodies, and then, when the existing Western-led institutions don't grant them the access or the rules they want, they simply create new ones.
Let's start with the literal frontier.
Yeah.
The deep seabed. This seems to be purely about securing a chokehold over critical minerals needed for the future of technology.
That's exactly it. We are talking about nickel, cobalt, and manganese, the essential components of high-capacity batteries and advanced electronics. China recognized this potential decades ago. They started research way back in the late 1970s.
So they've been playing the long game on this for a while.
A very long game. They now possess the world's largest fleet of civilian research vessels and deep-sea exploration capabilities.
And how does that translate into tangible control? It's one thing to have the ships.
It's another to have the rights. They translate those capabilities into claims. They hold 5 seabed mining exploration contracts from the International Seabed Authority, that's the UN body that governs these resources, and 5 is the most of any country.
So that puts them in the pole position to begin commercial extraction the moment the ISA approves the regulations.
The very moment. And this is creating significant friction. It really is.
How so?
China is advocating very strongly for accelerated mining regulations to begin extraction as soon as possible. This pits its resource security interests directly against global environmental concerns.
Right. And you have nearly 40 ISA member states, many from the Pacific Island nations in Europe, who are supporting a precautionary pause.
A pause until rigorous environmental safeguards can be implemented. And what's more, you have to remember these deep-sea vessels serve a critical dual-use function.
They don't just find minerals.
They don't just find minerals. They map the ocean floor, which is essential for laying undersea cables and, more critically, for naval and submarine warfare. It provides China with both a commercial and a military advantage.
Okay, so moving from the deep sea to the freezing north, the Arctic, or what they're calling the Polar Silk Road. This is about securing new shipping corridors and resource access.
The geopolitical shift here is tangible. The sources we looked at highlighted the successful journey of a cargo ship, the Istanbul Bridge, in late 2025. It completed the Northern Passage weeks faster than the traditional southern routes through the Suez Canal.
A huge time and cost saving.
Huge! And China views this as a vital new area for commerce and for resource extraction, oil, gas, rare earths, you name it.
And they are leveraging Russia's isolation to gain that access.
Precisely. China is investing very heavily in strategic infrastructure through these partnerships with an economically isolated Russia. We're talking about funding a new railway, a deepwater port on the Arctic coast, and investments in major resource projects like a titanium mine and a lithium deposit.
So China gains shorter shipping routes and access to critical inputs. But where did the West draw the line?
Well, the democratic Arctic countries, so Canada, Denmark via Greenland, they recognize the security threat of Chinese dual-use investments. They've rejected or canceled numerous Chinese investment projects related to sensitive infrastructure, and that has limited Beijing's territorial reach.
So that forces China to rely almost exclusively on Russia for any regional expansion in the north.
Right. It creates this shared geopolitical destiny between the two powers up there.
And the final physical frontier,
Yeah.
outer space. China aims to be a leading space power by 2045.
Their key move here is establishing the International Lunar Research Station, or the ILRS, in conjunction with Russia. This is a direct, tangible alternative to the U.S.-led Artemis Accords.
So it's offering a non-Western path for space resource extraction and exploration.
Exactly. It's an attempt to establish a different set of norms, or perhaps, no norms at all, for how we manage the moon and beyond.
Is the ILRS gaining the same kind of diplomatic traction to match its ambition?
Not yet. The Artemis Accords have recruited around 60 nations. They appeal to smaller states through established scientific relationships, norms of transparency, interoperability. The ILRS, by contrast, only has about 11 partner states plus China and Russia.
Got the difference.
It's perceived by many as an attempt to colonize and establish sovereignty over the moon, which is a much harder sell diplomatically than the U.S. proposal for peaceful, shared exploration. So while the material investment is vast, the diplomatic appeal seems to have its limits.
Let's shift from the physical frontiers to how China is trying to hardwire control into the digital and financial architectures of the future. Let's start with cyber and this new IP standard.
Okay, so China is leveraging a current tangible strength here. Its 40% share in global telecommunications equipment, largely through Huawei and ZTE. They've used this market dominance to push their preferred technical and political standards through global bodies like the International Telecommunication Union.
New IP sounds like very dry, technical jargon, but you suggest it's a direct threat to open commerce and information flow. How so?
Because the new IP architecture is designed to fundamentally change how the internet functions. It would replace the current protocols that prioritize the decentralized free flow of information. The new IP proposal explicitly embeds technical features that facilitate state control.
Making it much easier for central authorities to do what?
To execute network shutdowns, to identify and track individual users, or to filter specific content streams on a global basis. It's an attempt to hardwire Beijing's technical and political preferences for surveillance and censorship directly into the next generation of the global internet.
That is profound. And while it's been resisted by the West, this standard did gain traction in Africa. Why there?
It comes down to financial leverage. African states were motivated by financing provided through the Digital Silk Road, which promises to close their digital divide. This just shows how China uses financial incentives, these massive infrastructure loans, to export and institutionalize illiberal governance standards globally.
Moving to financial leverage, de-dollarization. The goal is clearly to reduce the U.S.'s unilateral sanctioning power, which, relies on the dollar's global ubiquity.
This is a long game, but the infrastructure for it is showing accelerating growth. China's cross-border interbank payment system, CIPS, is their SWIFT alternative, and CIPS grew 47% in 2024.
47%. I mean, compared to just 12% growth for the Western-dominated SWIFT system, that's enormous. What is driving that use?
In a word, sanctions, or sanctions circumvention. CIPS is now critical for countries that the U.S. and its allies have sanctioned, particularly Russia and Iran. For example, 99% of Chinese-Russian trade is now settled directly in renminbi or rubles.
Bypassing dollar-denominated financial systems entirely?
Completely. This infrastructure creates resiliency for that illiberal network, and it directly challenges the U.S.'s ability to impose financial penalties unilaterally.
But here's the question. If the renminbi is so central to this new network, why hasn't it become a dominant global reserve currency? It's still, what, around 2.1%? It's minor.
That's the key constraint, and it brings us back to something called the economic trilemma. This is where politics directly clashes with finance.
Explain that.
For the renminbi to achieve full internationalization and genuinely challenge the dollar, the Chinese Communist Party would have to dismantle its existing capital controls and allow far greater financial liberalization.
Meaning letting capital flow freely in and out of the country.
Right. And the CCP resists that. They resist it fiercely because that level of openness would fundamentally undermine state control over the economy.
The trilemma says you can only choose two of these three: fixed exchange rates, free capital flow, or independent monetary policy.
And the CCP always chooses control. They choose fixed exchange rates and independent monetary policy over free capital flow. To adopt free capital flow would risk massive, potentially destabilizing outflows, and it would reduce the party's ability to direct the domestic economy.
So in this conflict between economic modernization and political control, the party will always prioritize party control.
Always. The political risk is simply too high for full financial openness.
That's a powerful insight. The limits of China's financial power are fundamentally political. Let's pivot to the domestic economic consequences of this focus on industrial expansion, what the sources are calling the capacity paradox.
Right. China's immense industrial capacity, which is the foundation of its power and the source of its wealth, is now creating intense oversupply. They produce far, far more than their domestic market can absorb.
Which forces them to rely heavily on foreign markets to soak up all that excess output.
Exactly. And that reliance is forcing the world to de-risk.
Because the rest of the world sees this strategic reliance on exports, coupled with the opacity of their system, and is now actively reducing its dependence on Chinese supply chains.
Precisely. Their greatest strength, this massive capacity, has in a way become a geopolitical and financial liability because it accelerates de-risking actions by other countries.
And this is all compounded by domestic weakness, specifically a real lack of consumer demand.
There is chronic weakness in household demand. Retail sales growth was around a very low 3.5% in 2024. When you combine that with oversupply, it creates deflationary pressure,
Forcing companies to export at razor-thin margins or even dump product below cost.
which just exacerbates trade friction with the West. And furthermore, this entire economic picture is unfolding against the backdrop of an aging, shrinking population.
What's the financial implication of that aging population?
A massive future social welfare burden. China will inevitably need to scale back its overseas investment projects like the Belt and Road Initiative to fund the increasing healthcare and pension costs of its large, rapidly aging demographic. This structural shift means the capacity for that kind of long-term global investment is likely to contract over the next decade.
So if capacity and capital are China's material strengths, what is its biggest weakness in this global contest?
It's the profound credibility deficit. The accumulation of wealth and power, coupled with the opacity of its governing system and this purposeful blurring of state and commercial lines, it all creates deep distrust.
So Beijing is viewed globally as formidable, yes, but not trustworthy.
Exactly. Its power is legitimate domestically, but it struggles to inspire allegiance internationally. It can only get transactional solidarity based on shared anti-Western interests.
And in a world that's demanding investment security and transparency, that lack of credibility limits its long-term global influence, regardless of its industrial scale.
It raises the cost of doing business. Corporations and countries seeking stability will always prefer a predictable partner, even if they're slightly more expensive, over an opaque one who might change the rules or seize assets on a political whim. The credibility deficit is the silent tax on China's global expansion.
Okay, now we turn to the global West. With China and the illiberal network rising, the reliability of the U.S. as the core guarantor of the global economic order is, well, dissolving. And this is forcing allies into costly defensive reorientations. They're all searching for a plan B.
And the central economic point here is that U.S. foreign policy has become explicitly transactional. The traditional model of alliances based on shared values and mutual security has been replaced by a doctrine of conditionality.
Explicitly linking security guarantees directly to financial contributions or economic concessions.
That's it in a nutshell.
So let's start with security for capital, the NATO model. How is this transactionalism hitting allies in the wallet?
The demand is brutally simple. Security guarantees, like NATO Article 5, are now conditioned on massive financial commitments. Allies have responded to this pressure by agreeing to increase defense spending to an unprecedented 5% of GDP by 2035.
5%. I mean, for major European economies, that requires either huge cuts to social spending, the guns versus butter trade-off, or ballooning deficits. It's a monumental, politically painful financial commitment.
Monumental. And the financial gain for the U.S. is crystal clear.
Of course.
This commitment is tied to purchasing American weapon systems and making investments in the U.S. defense industrial base. It's a huge, long-term financial boom for the U.S. defense sector. It effectively turns U.S. foreign policy into a massive sales mechanism for its military contractors.
But the transactionalism extends beyond defense and into trade, where allies appear to be accepting very unfavorable terms just to preserve those security links. We see this with the trade extortion faced by Europe.
European leaders were caught in a profound strategic submission trap. They accepted 15% tariffs on most EU exports.
And that's a rate that's 5 percentage points higher than what the UK negotiated after Brexit.
Yes, and this wasn't because the U.S. couldn't impose higher tariffs. It was because the EU dared not retaliate.
Why the submission? Why not leverage the EU's enormous collective market power?
In a word, fear. The submission was motivated entirely by fears that aggressive retaliation would cause a recession within the EU, and, more critically, that it would risk the U.S. withdrawing military and political support from Ukraine, or, even worse, dismantling NATO guarantees.
So they chose geopolitical security over economic integrity.
They did. And the key economic consequence for the EU is that this submission is widely viewed as a humiliation. It erodes the original rationale for European integration in the first place, which was collective market strength.
It hollows out the institution. If the European Union, the largest unified market in the world, can't leverage its economic size to resist protectionist demands from its closest ally, then what is the long-term strategic value of the United Trade Bloc?
And it fuels the internal political forces that question the entire European project.
The transactional dynamic is even starker in Asia, specifically with the Japan, Korea, and Taiwan trade-off.
This is the pinnacle of weaponized economics. The U.S. has threatened to condition the defense of Taiwan and existential security guarantee on Taipei, moving half of its advanced shipbuilding capacity, meaning TSMC, to the United States.
This is a demand for a massive, multi-billion-dollar economic asset transfer in exchange for a security commitment. And it directly impacts the entire global semiconductor supply chain.
It shows that Washington now views control over critical technology supply chains as inseparable from, and sometimes even superior to, traditional geopolitical security interests.
And for Taiwan, TSMC is their silicon shield. It's their primary source of economic and political leverage against Beijing.
And the U.S. is demanding that they relinquish half of that shield as an insurance policy. This forces allies all across Asia to view their most valuable domestic industries as political leverage points that their supposed security guarantor may seize or relocate at any time. The cost of U.S. reliability is rising exponentially.
So why hasn't Europe mounted a unified economic or defense pushback? If the threat is so clear, why this submission trap?
Political division is the primary financial and strategic inhibitor. The accelerating rise of far-right, nationalist, and populist parties across Europe has stiffened internal resistance to any collective EU defense and trade initiatives.
They just can't agree on a unified policy.
They can't, and that forces accommodation with the U.S. because they simply can't present a strong, united front.
The numbers confirm this lack of ambition. It's a staggering defense inertia.
It is stark, especially when you compare it to recent collective action. The EU could only muster about $170 billion in loans for collective defense initiatives.
Which is a fraction of what they mobilized for COVID.
Yeah, exactly. It demonstrates a profound lack of ambition when you compare it to the over $900 billion mobilized during the pandemic response. This gap isn't about capacity, it's about political will. The failure is due to political infighting and the fear of a populist backlash over the guns versus butter trade-off. Social spending is politically popular. Defense spending often isn't.
And the political cost of this accommodation. It creates a self-defeating cycle, doesn't it?
It does. European leaders accommodating U.S. transactionalism, especially on protectionist trade policies and defense procurement, unintentionally normalize these illiberal protectionist policies.
Which then validates and strengthens the domestic far-right across Europe, accelerating the internal political erosion of the EU.
They are trying to placate Washington, but are simultaneously validating the ideological enemies within their own borders.
However, allies are finally accelerating these Plan B investments. We're talking strategic, costly moves toward economic sovereignty and self-reliance.
We are seeing immediate material changes in procurement. There is a clear shift toward restricting defense spending to be spent within the EU to build a sovereign defense industrial base.
Right. Germany, for instance, plans to spend the vast bulk of its $95 billion arms budget in Europe.
Explicitly bypassing U.S. suppliers where possible. And Denmark purchased a major $9 billion air defense system entirely from European ventures, not American ones.
These are financial decisions designed to de-risk their military-industrial bases from U.S. political volatility. And economically, Canada is making a significant move.
Canada announced intentions to double its exports to countries other than the U.S. by October 2025. This is a strategic de-risking move against U.S. protectionism and the threat of arbitrary tariffs. It's a recognition that relying primarily on the U.S. market, even for neighbors, is now a strategic liability.
And this loss of U.S. reliability is pushing security considerations to the absolute extreme, accelerating nuclear ambitions among key allies.
This is the most costly and strategically dangerous Plan B. The polling data is alarming. Over 70% of South Koreans now want their government to develop indigenous nuclear weapons.
70%.
Similarly, the defense agreement signed between Saudi Arabia and Pakistan suggests a potential pathway for the Saudis to acquire or develop a future nuclear deterrent, moving away from reliance on historically unpredictable U.S. security guarantees.
So the U.S. is successfully extracting immediate financial gain from its allies, but at the cost of fundamentally fracturing the traditional security structure, pushing those allies toward expensive and potentially destabilizing nuclear self-reliance.
The short-term gain for the U.S. defense industry may very well lead to long-term global chaos.
Finally, let's look at some critical regional shifts. Latin America's new political alignment and the precarious position of U.S. policy in the Middle East, and how these regional dynamics are generating substantial global financial and security consequences.
Latin America is undergoing a profound political realignment. And it's driven not by traditional ideology, but by existential public safety concerns, crime and migration.
The numbers are stark. The region accounts for 30% of global homicides.
And that's fueled by the tripling of cocaine production over the last decade. This level of pervasive public fear is pushing voters toward iron-fisted, security-focused leaders, favoring action over any kind of political dogma.
And this shift has enabled the radical economic experiment we're seeing in Argentina, the Milei economic model.
Right. Javier Milei's anarcho-capitalist policies were immediately characterized by massive cuts to government bureaucracy, deregulation, and a dramatic reduction of the central bank's power. And these shock therapy policies managed to reduce inflation from over 200% when he took office to about 30% by late 2025.
A drastic, though incredibly painful, turnaround.
Very painful. But this volatility and this sudden swing toward market orthodoxy generated an immediate strategic response from Washington.
Of course it did. The U.S. Treasury saw this as a pivotal moment to counter rising Chinese influence.
Yes, and so Argentina received a massive $20 billion U.S. rescue package. And critically, the U.S. Treasury Secretary framed this explicitly as an economic Monroe Doctrine, a clear signal that Washington is willing to use massive strategic bailouts to steer geopolitical alignment in the hemisphere.
To counter China's long-term infrastructure lending.
Head on. And this rapid shift toward pro-market policies attracted substantial corporate enthusiasm and capital flow.
The financial market reaction was intensely positive. Argentina's stock index was up 30% in 2025.
Investors anticipated greater returns and regulatory stability under this low regulation regime, but the most concrete signal of future capital flow came from the tech world. Sam Altman, CEO of OpenAI, announced plans to invest up to $25 billion in AI data centers in the country.
$25 billion. Why Argentina for that scale of tech investment?
It's the combination. Perceived regulatory freedom, low taxes, available talent, cheap energy, coupled with a government that explicitly champions a libertarian, tech-friendly economic policy. It creates an enticing new hub, especially when you compare it to the regulatory burdens in Europe or the U.S.
So who gains and who loses from this capital infusion and political shift?
Well, investors anticipate greater returns and stability. The U.S. gains a major new ally and counters Chinese influence effectively with strategic finance. And China risks losing influence and leverage in the region.
Most notably, the potential curtailment or termination of its lease on that deep space station in southern Argentina,
which the U.S. views as having significant military potential. This is a direct contest between U.S. strategic bailout finance and China's long-term infrastructure investment model.
Now let's turn to the Middle East. and the analysis regarding the U.S.-Israel relationship, which the sources dub the end of the Israel exception. The war in Gaza exposed the high costs of the U.S.'s policy of unconditional support.
The core finding is that the long-standing exceptional relationship, where Israel received unconditional military aid and diplomatic cover unlike any other wealthy U.S. ally, is economically and strategically detrimental. It creates a moral hazard where the recipient state has no reason to accommodate the U.S.'s geopolitical or humanitarian concerns.
And the economic leverage was proven effective, but only when Washington was willing to risk using it.
That's the key takeaway from the analysis. The only times the U.S. successfully influenced Israel's conduct on the ground, specifically regarding humanitarian aid delivery into Gaza, were when Washington threatened to reduce or condition military support.
So it demonstrated that conditionality is an effective tool to shape behavior, while the traditional unconditional model is not.
Exactly. So normalization, meaning applying U.S. law and standards as it would to any other wealthy ally, has profound economic and diplomatic implications.
What would that look like in practice?
If the U.S. were to normalize relations, it would mean applying U.S. laws like the Leahy laws, which restrict aid to military units credibly implicated in human rights violations. It would also lead to a reevaluation of the immense $3.8 billion annual military aid package.
Provided to a wealthy country that now actively competes with U.S. arms manufacturers for foreign sales.
Right. That financial assistance actually puts U.S. manufacturers at a competitive disadvantage in the global market.
And financially, normalization provides a direct, measurable cost mechanism for controversial policies like settlement expansion.
Absolutely. The concept of conditionality would mean reducing aid by the amount Israel spends on expanding settlements in the West Bank. This provides a clear, measurable financial consequence for annexation policies and West Bank expansion. It removes the financial impunity that unconditional support currently provides. It's the financial mechanism required to create compliance.
And the long-term analysis concludes that this unconditional U.S. support has paradoxically contributed to Israel's international isolation, which in turn weakens its long-term security.
Yes. Unconditional support removes the incentive to seek regional peace or maintain robust international standing. Israel's international diplomatic isolation has deepened, with key partners like the UK and Germany restricting arms sales.
And even more concerning is the shifting ground within the U.S. itself.
The polling is very clear on this. A recent poll found that over half of all Americans, and critically, 2/3 of those under the age of 30, now oppose providing additional military support to Israel.
That domestic opinion shift represents a profound long-term financial and strategic risk factor for Israel's future security relationship with the U.S., regardless of who is in office. The exception is ending, and the financial consequences are about to become very real. So what does this all mean for you, the listener? To boil it down, the current era is defined by the weaponization of economic power. On one side, you have China using its long-term capacity, its industrial oversupply, and its alternative financial architecture like CIPS to build geopolitical leverage, even if it creates these domestic paradoxes.
And on the other side, you have the U.S. rapidly abandoning its role as the stable global guarantor. It's replacing reliability with a doctrine of transactional conditionality, explicitly linking security commitments to economic concessions from its allies.
Forcing them into these costly, long-term de-risking strategies, like building sovereign defense bases and even seeking nuclear options.
And the key risk for investors, for corporate leaders, for supply chain managers lies precisely in this geopolitical uncertainty. It's the rapid, unpredictable erosion of predictable global rules, whether that's in trade, security, technology standards, or even currency settlements. This volatility, which is fueled by political intent, is the new normal you have to orient yourself toward.
And if we connect this to the bigger picture, it seems the choices of the middle powers of the global south will fundamentally shape the stability of this coming multipolar world.
They absolutely will. They are leveraging the competition between the West and the East to pursue multi-alignment. They're seeking to maximize their own autonomy and their own influence. The structure of the next global order really rests in their hands. They decide who receives their trade, their resources, and their political allegiance.
That is a critical point to leave you with, but our deep dive into the 2026 global landscape reveals an even deeper, maybe more provocative tension. A tension between all this global geopolitical conflict and fundamental demographic trends.
The sources reference what they call the depopulation panic, noting that fertility rates are falling so rapidly that the global population is estimated to peak sometime between 2060 and 2080 and then begin to contract precipitously.
The core economic idea here, championed by some leading economists, is that human ingenuity, so the number of new minds and new ideas entering the workforce, is the ultimate resource that drives innovation, technological progress, and prosperity.
So if you accept that assumption, then what happens to our current era of intense geopolitical rivalry?
It raises a very important question. Can a world focused entirely on achieving military and economic dominance over its peers sustain the necessary progress? Can we solve monumental, epoch-defining challenges like climate change, technological competition, and financial instability if the fundamental engine of innovation, human numbers, and the scale they provide begins to contract globally?
If population shrinkage leads to fewer innovators available to tackle these monumental tasks, the entire long-term economic outlook changes, regardless of whether the US or China wins the short-term trade war. This is a profoundly disruptive, quiet threat to consider.
The ultimate geopolitical rivalry may not be between East and West, but between humanity's ambition and its ability to reproduce the innovators it desperately needs. Thank you for joining us for this deep dive.
Always a pleasure.